So this is a energy margin bridge based on effectively our initial guidance for results last year. So this is stepping up to energy margin. We had a guidance of 391 million for EBITDAF. Energy margin is essentially the difference between our total sales and direct costs, including purchases. You can see almost $31 million uplift on what we were expecting. So this takes account of Ngāpurewa being inside that portfolio, so you're not seeing that $50 million movement we saw in the earlier bridge attributable to Ngāpurewa, because it's already buried inside the 624 million. So what do we see here? You see low prices impacting your hydro, your generation business, so lower revenues to physical generation dispatch from hydro, partially offset to the tune of almost 20 million by increases in hydro volumes. You match that across to end user sales, so this is looking across the entire sales portfolio at 71 million. So you've got quite a hedging match there. So lower prices, you expect to see higher profits in your retail book, lower profits in your generation portfolio. Total bridge across up almost 31 million for the year. So the key point there being portfolio positively skewed to higher returns as a consequence of those low prices and favourable results as a consequence of higher hydro. So this takes those results now and extends it to the EBITDAF bridge, again based on guidance. So our initial guidance was 391. We revised that twice during the year, and our final earnings at 443 were inside our guidance issued in June. So we can track across effectively through the sales line, that matches what was on the previous chart, and we see another $20 million additional EBITDAF accruing from other income. That's mostly increases in O&M recoveries from our geothermal operations and reductions in operating expense of nearly 14 million, taking us to the closing EBITDAF for the year of 443. Again, quite an obvious hedging impact there between our sales book and our generation position. Just looking at operating expense, certainly when we cast our mind back to some of our EBITDAF results over recent years, a lot of the increases in energy margin were eaten away by increasing operating costs. This year we've, as you can see, operating costs just up 3%, so a little bit more than 1% for the year. So quite a lot of containment there in the OPEX line. Sales and marketing up 3% relative to where we expected, again reflecting the increased competition and customer churn. So a lot of that going into retention and sales and marketing initiatives. Professional fees up 4 million above what we expected, and about half of that's attributable to professional fee related costs from GGE consolidating back into our OPEX line. So now we bridge between EBITDAF down to bottom line performance at the NPAT. Change in fair value of financial instruments. So this is one of the, as it says, one of the wonders of IFRS. It's mostly related to interest rates, the cross-currency interest rate swap, because of the difference between the inception of the swap itself and then the drawdown of the debt, which happens 6 weeks later. We end up with an inception adjustment, which is an adverse movement. Again, it's just a vagary of IFRS. And the fact that interest rate curve for New Zealanders at large was lower this year than the preceding year, also leading to that $26 million adverse movement in financial instruments. Depreciation amortisation, pretty chunky at 145 million. Quite a big increment as a consequence of two things. One, the full year depreciation on Ngāpurewa, and two, the valuation that was put through at the end of last year, feeding through. So that increased depreciation by $23 million for the group. Impairments at 19.8, still quite a large number, related to three key issues. A geothermal well at Kawerau being written off, so it's a blocked well there. That relates to more than half of that number. And then the write-off we have of $3 million in the half year relating to upstream gas exploration. So that really concludes that part of our foray into gas. So we've exited the upstream gas strategy. And we had a number of just smaller project write-offs related to small, mainly hydro developments which have been progressed over the last few years. Those are unlikely to proceed at this time and so have been impaired. Interest expense, 72 million. See the comparisons here. Interest expense, quite a lot up. So again, negatively impacting net profit after tax. Key changes there relate to three things. Increase in average level of debt. So while our opening and closing debt was almost identical, the opening debt at the beginning of FY10 was quite a lot lower, by about $150 million. So high level of debt, higher interest rates as a consequence of our swap book, and got here. I think we talked about the key variances. Probably just back up the top, you can see quite a big movement. So almost over 45 million movement there in that depreciation line. We also had a $16 million positive amortisation last year relating to a release from the cash flow hedge reserve for a foreign exchange transaction relating to a prospective geothermal development. So that artificially skewed down depreciation amortisations in FY10. But anyway, very good result. NPAT up 50%. There's not too many firms presenting a NPAT movement of that magnitude, though again somewhat influenced by accounting constructs of IFRS. So we'll go to the next slide. Talk about underlying earnings, which back out some of that weird stuff. So really making adjustments for those fair value derivatives and impairments, and so we see a 16% increase year on year. Again, both NPAT and underlying earnings impacted by our revaluation policy. So the revaluations historically have been positive, and that is pumping our depreciation line, so adversely impacting both underlying earnings and net profit after tax. Again, so just jumping into the balance sheet to see what's key movements here. Had a fair chunk of cash at the end of the year, most of that related to cash reserves from our offshore interests in GGE. So actually relatively, we try to minimise our cash balances here, rather repay debt than hold cash. Asset revaluation, so it's quite significant. That's undertaken independently by PricewaterhouseCoopers. So over $400 million revaluation there. Split not quite evenly between the geothermal and hydro portfolios, so hydro being slightly larger. So quite a large increment, and again that increase there feeding through to the TSR of over 11% in FY11. Some movements there around conversion of advances loans to equity in respect of the offshore interests. We have a translation movement in terms of the carrying value of offshore investments, so appreciating currency, shifting the carrying value of that asset by 20 million. Loans, you can see not really moving, 985 closing versus almost 980 the year before. So effectively operating cash flow matching CapEx and dividend outgoings for the year. And then again another wonderful IFRS impact where an asset revaluation is split between equity and tax rate times the valuation goes into deferred tax. So again, pretty chunky deferred tax liability sitting there at 875. The vast majority of that relates to deferred tax on revaluations, which given the absence of capital gains in New Zealand will never crystallise. But again, IFRS requires us to report it that way. So again, quite a large jump in shareholders' equity to over 2.9 billion. CapEx. So FY11 was a bit sad from a CapEx perspective. So it was the first year we weren't building a major power station until we started Ngā right at the end of the year. So quite a reduction there you can see in that geothermal spend, which has been pretty significant as we completed both Kawerau and Ngā Aotearoa. We can see a forecast there for FY12. Again, quite a significant uptick. So it's a big year for us. We expect to see debt climb quite significantly over this year. Again, attributable to two things. One, Ngā Tamariki, So we'll see a fair chunk of the 466 million roll out this year, along with the progression of a number of GGE projects, which Doug will talk to later today. So we are forecasting the highest level of CapEx in Mighty River Power's history in FY12. The bottom bar there, you can see an uptick also in reinvestment expenditures. So those relate to stay in business. We signalled last year and we signalled at the interim, we are seeing quite a major refurbishment program happening on the hydros. And so that's underway. So there's some reasonable expenditures there. We expect to see reinvestment CapEx to be elevated above historic levels as those key programs roll through. And we've got a systems refresh at Mercury in terms of the SAP system, which has largely been there since Mighty River existed in '99. So we are seeing a systems change there. So cash flow statement, we can see, as I said, interest cost up significantly due to those reasons already explained, but moving from almost 50 to 76 million, so quite an uptick there in interest costs. And you can see dividends there. Special dividend last year of 150 million, driving that 286 dividend payment last year. Debt maturity, so it was a pretty busy year from a debt perspective for Mighty River Power. You see our maturity at over 6 years, so it's longer. It's about a year longer than it was a year ago. A lot of refinancing. So of our drawn book, we refinanced over half of it. So that included a USPP end of last year of 260 million, with the remainder going through new bank facilities. So total facility sitting at just over 1.3 billion, and quite a lot of headroom at over 300 million at this point in time. Maturity-wise, we're still a fair way out from any of those debts expiring. So with our retail bond coming up due in May 2012, with some bank facilities at the end of that same year of 250 million. In April, S&P finally got around to doing our annual review 9 months after the fact, and reaffirmed our BBB+ credit rating. We were on negative watch last year, but S&P now are quite confident with the outlook for the firm despite the capital program contemplated. So we're sitting there at BBB+. So we've just got a few graphs here around generation flexibility. We believe it's a key advantage of our portfolio. So we can see here blue bars are hydro. This is for a time series for this financial year. You can see the movements. Certainly September, you can see peaking. So that was our first flood event for this year. And with another pretty heavy generation position in March, which is certainly a lot higher than you'd expect for that time of the year. And quite dry conditions in the December period. Spill this year was astronomical at 411 gigawatt hours, so almost 10% of total output. I think in 2004 we spilled almost 90 gigawatt hours, and we were pretty excited about that. So 411, just a lot of rainfall happening in relatively short periods of time, and seeing quite a lot of spill across the hydro catchment. Unfortunate, we prefer not to spill, but at the end of the day, we can't keep it in the river, and a lot of that spill is eventuating from, well, it's all eventuating from tributary flows to the Waikato. High prices, you can see the VWAPs there for South Down. So March, there were 2 events in March. The infamous UTS on the 26th, but about a week earlier there was another high-priced event also, and that's really contributing to South Down earning a VWAP of almost $400 a megawatt hour in that March period. So we can see December prices being relatively high in that month, South Down generation coming up, and just as in the July and August of 2010, South Down also generating. What we can also see is there's some months where South Down barely operated. So 200, just over 200 gigs for the year. That is the lowest generation we've seen from the South Down plant. So some of the issues certainly our competitors have had, particularly contact around take or pay flexibility and uneconomic dispatch of thermal plant. Not really an issue for us given the flexibility afforded by both our plant and gas contracts. So this is a similar chart showing similar data, but we have added the storage line there. So you can see the Taupo storage in black running off the left-hand axis So Taupo full is 580 gigawatt hours, and so you can see in September the rapid rise in storage level. That normally means, well, it means one of two things: either you're not generating or it's raining a lot. And in this case, it was raining a lot, and so I think we exceeded our normal operating limit in that month. So really, again, something we try to avoid, but very wet conditions did see Lake Taupo peak. And then again, you can see another inflow event throwing at the back of in the sort of summer there, where storage again peaking. Typically seeing a negative correlation between hydro output and Southdown. Certainly for us, it's if wholesale prices are depressed, which they have been for most of the year, well, there's no point running Southdown and losing money, so we just buy from the wholesale market. So this shows our adjusted net position by month for the company looking back over the last year. So we can see the orange line there does show that on average the company is, by choice, short on a monthly basis. What we can see here is spare Southdown capacity, 1100 gigawatt hours. So that was how much we didn't generate. Our annual adjusted net position was around 800 gigawatt hours short. So clearly in that circumstances, in terms of operating Southdown, what that means is lower prices will generally increase profits as a consequence of that short book. So, and you certainly saw that through on our EBITDAF results. So again, key issue here, flexibility in the portfolio. We choose not to run Southdown, not to be long, because it is cheaper to buy from the wholesale market than to generate at the Southdown plant. So some of you hopefully have noticed that on a quarterly basis we do generate some operating information, so it's hopefully of some use to the analysts in the room in terms of determining just exactly what's happening at Mighty River Power in terms of sales and generation levels. So you can see here over 7,000 gigawatt hours of purchases. That does include the spot component, which from a risk perspective, while it has credit risk, they don't pay, but we've never had a large customer default. Carries no market price risk, as the customer accepts the volatile wholesale price. And generation, so in terms of our purchases, generation by itself, they're actually relatively closely matched. Some information around gas, so you can see a slight reduction in retail gas. So our retail gas sales are all to residential customers. Well, probably not all, 99% of them are to residential customers, and we don't sell gas by itself. So for us, gas is a bundled product with electricity. It's really something of convenience. A customer wants to have one gas and electricity bill and not two. So it's not big by any stretch. Cogeneration, seeing there quite a lot lower due to the reduction in output at Southdown. So a bit over 4 PJs a year of gas. And that's putting that in the context of New Zealand gas demand of about 140. 150, so we're pretty small gas user in the context of the New Zealand system. Quite a big increase in gas prices, so that certainly does increase the dispatch point for Southdown, at what point it is economic to generate. And again, based on disclosures we can see from Contact, that's $8 a gigajoule wholesale price, still looking pretty competitive. Just update on carbon. So ETS is in now. We must meet at least 50% of our generation emissions. So you can see here for the financial year, generation 446 kilotons of carbon, resulting in 223,000 tonnes of carbon liability for the year. Last year, no liability, ETS was not in. So slight increase in really the movement 418 to 446 will be driven by Ngāpurua coming online, so geothermal do have a carbon footprint, and the reduction at Southdown obviously works slightly against that. Good thing for us is our carbon credit position, so credits either awarded or going to be awarded to us from the government for free, 1.4 million credits. So given our liability currently sitting at 223,000 tonnes, it's going to take a fair while before the company finds itself in a position that it will need to acquire credits. That being said, we have entered into a number of long-term offtake agreements for carbon with forestry owners already. They typically have a profile that grows over 6-7 years, and then flat lines for the duration of that agreement in accordance with the growth rate of the forest.